Major stock indices at session lows right now. Treasuries aren't trading today for Columbus Day, but certainly the market is reacting to this spike up in rates, and it's left a lot of investors concerned. Joining us now to talk about it is Jim Polson, Chief Investment Strategist at the Leupold Group, and Dana Peterson, economist at Citigroup. Jim, we just came off of the worst week for the NASDAQ since March, so Russell as well got very beat up, and the mood has turned sour again this morning. What's driving it? Is this fear of rising rates?
Well, I think that's certainly part of it, Sarah. You know, a follow through from what we went through last week, and perhaps more to come. We're going to face both PPI and CPI reports later this week yet. But I also wonder, not only is the overheat pressure now on Wall Street's mind, but the real kicker would be now if real growth slows, not only here but globally. And I think there's some growing evidence that may be the next shoe to drop. We've already had the OECD leading economic indicator for the globe roll over. Has been coming down in the last few months. And here in the United States, we've got, cyclicals that are getting beat up. You've talked about it earlier that it isn't just today, but you go back to utility stocks have now matched the market since like January 5th of this year. Staple stocks have matched the market performance since almost April. You've got a good part of this market in recent months that's been led by defensive stocks. They can't be saying, rates is the primary reason. I think it has more to do with this nervousness about growth. And if you put that together with 10% drop in industrial commodity prices since June, and weak housing, weak autos, weak durable goods spending, if we drop growth right now and remove those fantastic fundamentals and we leave a higher rate structure in place, that's where the pressure would really intensify on stocks.
So if it's a global growth story, Dana, the question becomes, how resilient is the U.S. going to be? I mean, we just got another very strong employment report, especially with that lower unemployment rate. How strong is the foundation to withstand a downturn in global growth that looks, as Jim said, a little worse than first appeared?
Our forecasts have the U.S. continuing to lead the global economy. Indeed, there are a lot of concerns about slowing in China and emerging markets and also potentially in Europe. But remember, we had roughly 4% growth in the second quarter in the U.S., and we're looking at probably 3.5% growth in the third quarter, and maybe again 3% in the fourth quarter. So even though those numbers, 3.5%, 3% are lower than 4%, we're still looking at very significantly strong growth in the U.S. economy. We're still growing materially above potential, and we think that there's still more room to run with respect to the boost from tax reform and certainly the Bipartisan Budget Act on the U.S. economy, not only for the balance of this year, but also for next year.